there is no precedent in financial history for what we're going through today. So in the 1800s in the US, you have a number of real, very severe busts, deflationary busts, that have been documented. 1814, I think, was the first one, but there are at least 5 during the 1800s, where basically a number of banks went under. You had a massive contraction in money, and as a consequence, GDP falling 5, 10, 20%. Very sharp drops, followed by very sharp recoveries. And throughout the 1800s, actually, growth was very uneven, but was strong. What happened in 1929 was that a bust of that nature happened when there was a tremendous amount of debt, which was not the case in the 1800s. And as a consequence, there was a negative spiral that is well documented that Bernanke had studied. And we had something very similar happen in 08, 09. And I think he reacted, in hindsight, I think he reacted well with QE1 and trying to stabilize the whole system. Now we are in a situation where we want total debt to GDP to come down, and the Fed is trying to get GDP up, and they want nominal GDP up. And to get nominal GDP up, they would like CPI inflation. And they have printed a tremendous amount of money, and all they're getting is asset inflation, no CPI inflation. And I believe that's why they're targeting unemployment, because they think if we get to 6.5%, 6%, perhaps there'll be wage tension. And if you have wage tension, just like in Japan, that's the best way to get inflation. I'm not sure that they get wage tension at 6, 6.5. I don't know. What I would tell you though, if they manage to get wage tension, it's probably very negative for equities. Because if you have the share of labor going up as a percentage of GDP, then profits to GDP would probably come down in the US. So we understand today that we are in a very different world, very unusual world. It's either the holy grail of central banking. They are able to deal with their own failures as central bankers, having let the debt to GDP move to levels that are too high, or financial history will show that they're not able to deal with these things well, and they lose control. I don't know whether that's one or the other. What I do know is this. A good, I think, rough metric of valuations might be market capitalization to GDP. It's a sort of price to sales ratio. Market cap is the total value of corporate America, and GDP's production in America. So you get a price to sales ratio. And on that ratio, now you're 125%. That's very high by historical standard. It's very close to what you had in 2007. It's lower than what you had in 2000. 2000, you had 140%. It tells me that it's time to be cautious. And that's not the only sign. So there is a valuation, overall valuation, that tells me, watch out. Then you have a very lax high yield bond market that tells me, be careful. You have flows back into equity products from mom and pops that tells me you're closer to the end than the beginning of the bull market. And all of these combined tend to tell us, yellow red flags.